All right, welcome to this explainer. Today we're really opening up the hood on a massive, highly complex global engine, the mechanics of passive income taxation. Now, to be clear, we aren't looking at your basic, everyday tax tips here. Instead, we're strictly analyzing the cause and effect of how passive income is geographically sourced, forcefully categorized, and ultimately taxed or strategically protected across global jurisdictions. We're going to dig deep into the underlying logic that tax authorities use to capture revenue, exploring actionable insights and some really crucial, non-obvious details. Let's get right into it. Our analytical framework today covers 5 core pillars. First, defining passive income categories. Second, sourcing interest and dividends. Third, the tax withholding mechanisms. Fourth, the strategic use of treaties. And finally, mitigating double taxation. Starting with Section 1, defining passive income categories. Okay, before authorities can even think about taxing this money, they have to categorize it. And tax systems use some very heavily ring-fenced terminology for this. What we call passive category income is fundamentally your investment-type revenue. We're talking about interest, dividends, rents, royalties, and gains from the sale of property. The entire system is purposefully designed to explicitly sever your passive investments from your active wages or your general business operations. You don't just throw all your cash into one big bucket. So why go through all the trouble of building this distinct legal wall? Well, strict categorization is actually a structural defense mechanism. You see, the implicit assumption from tax authorities is that taxpayers will naturally try to artificially blend their high-tax business revenue with their low-tax passive revenue just to manipulate their overall liabilities. By locking passive income into its own distinct separate bucket, the system ensures that excess taxes paid over in one category literally cannot be used to wipe out what you owe in another. It's a highly calculated restriction. Let's move on to Section 2, sourcing interest and dividends. Now, you might intuitively assume your investment income legally lives wherever you happen to live, right? Actually, it doesn't. And the mechanics here are fascinating. For interest income, the geographic source is determined entirely by the residence of the payer. So if a foreign entity pays you interest, that income is strictly foreign sourced. Dividends, on the other hand, play by a different rule. They're tied directly to the domicile of the originating corporation. If a domestically incorporated business pays you a dividend, it is domestically sourced. And that holds true even if literally 100% of that business's actual daily operations are located halfway across the globe. And this culminates in a rigid, fundamental regulatory principle. Domestic authorities tax their residents on their worldwide income, period. But non-residents, they are taxed strictly on domestically sourced investment income. This is exactly why pinpointing the exact geographic source of every single dollar is mathematically crucial. It's the ultimate trigger. It completely determines whether a specific jurisdiction even has the legal authority to touch that dollar in the first place. Which brings us perfectly to Section 3, the tax withholding mechanisms. 30%. Just let that number sink in for a second. This is the heavy default statutory liability applied to non-connected, domestically sourced passive income when it's paid out to non-residents. You might be thinking, wow, why is it so incredibly high? Well, because it's designed to act as a forceful compliance mechanism. Unless a very specific legal exception applies, a massive 30% of the gross investment is legally mandated to be extracted right off the top. And here's the kicker. This extraction is entirely automated. Financial institutions essentially act as withholding agents. They're the intermediaries. They automatically apply that 30% statutory rate to the gross payment. They pool the withheld income by highly specific rate codes, and then they report that consolidated data straight to the government. The investor never even writes a check. The capital is simply intercepted at the source before you ever see it. All right, on to Section 4, strategic use of treaties. So are you just stuck with that 30% hit? Not necessarily. We have a very clear cause and effect relationship here when it comes to international agreements. On one side, you have that heavy statutory rate liability, that default fixed percentage applied universally. But on the other side, you have the treaty rate liability. To incentivize global investment, bilateral treaties between countries can drastically reduce, or sometimes completely eliminate, that default withholding percentage on income like dividends and interest. It can literally be a game changer for your bottom line. But there is a critical, non-obvious detail here, and it's absolutely crucial to understand. These treaties are never, ever automatic. The system's default assumption is always maximum tax. To override that, you have to clear some strict compliance hurdles. You must actually reside in the treaty country, you have to actively invoke the specific benefits of that treaty, and you must physically provide documented, formal proof to the withholding agent before the payment is ever made. And failing to do that leads to a mathematically dangerous trap. Let's say a treaty limits your tax to, say, 15%, but you fail to invoke it, so the withholding agent defaults to taking the full 30%. You might assume your home country will just credit you for that extra 15% you lost, right? Actually, scratch that. They absolutely will not. Authorities classify that excess tax as non-compulsory. In the eyes of the law, you paid it voluntarily through your administrative silence, which makes it entirely ineligible for domestic tax credits. You're just out that money. Finally, let's look at Section 5, mitigating double taxation. If you want to mitigate being taxed twice on the same money via foreign tax credit, that foreign levy has to survive a very rigid legal stress test. First, it must legally be an income tax or a tax strictly in lieu of one. Second, as we just discussed, it must be legally compulsory. And, crucially, the taxpayer cannot receive a specific economic benefit in return for paying it. Because if you get a specific, tangible benefit back from that foreign government, domestic authorities immediately categorize it as a purchase of services, not a creditable tax. Now, here is the fundamental golden rule of double taxation mitigation. Authorities will absolutely not subsidize a foreign tax base. So, what does that actually mean in practice? It means a credit is never a guaranteed dollar-for-dollar match if the foreign rate happens to be higher than your home rate. Your credit is mathematically capped at what your domestic tax liability would have been on that exact same slice of income. So how do they enforce this cap? Through a strict equation called the proportional limitation fraction. You essentially take your foreign source taxable income and you divide it by your total worldwide income. That gives you a specific percentage, right? Then you multiply that percentage by your total domestic tax liability before any credits are applied. The output of that exact math dictates the absolute maximum allowable foreign tax credit you are legally permitted to claim. When you're accounting for all this, you generally have two mechanisms available. The paid method lets you claim the credit in the year the taxes physically leave your pocket. Alternatively, the accrued method allows you to claim the credit when the liability becomes legally fixed at year end, utilizing average exchange rates. But beware of the implicit trap here. Once you elect to use the accrued method, the system firmly locks you in. It becomes a permanently binding election for all your future years. You can't just bounce back and forth. We also have to factor in a highly technical but super important rate differential adjustment when it comes to capital gains and qualified dividends. Because these specific types of passive income usually enjoy lower preferential tax rates at home, you can't just plug their full value into our limitation fraction. The system forces a proportional reduction. And the underlying logic is pretty bulletproof. Authorities aren't going to let you generate an artificially massive foreign tax credit using income that is barely being taxed domestically in the first place. To wrap up our analytical deconstruction today, I want you to consider the massive financial stakes of this entire system. We've established that global treaties can override punishing domestic extraction, but they absolutely require aggressive, active invocation by the taxpayer. So ask yourself this: across the entire global economy, how many billions of dollars in passive income are being heavily double taxed right now simply due to investor silence? The mathematical cost of navigating global tax mechanics passively is, quite frankly, staggering. Something to think about. Thanks for joining me for this explainer.